Hi everyone, I'm Emma, a CPA and finance professional. Welcome back to FinWise. Today we're diving into one of the most important financial reports of any listed company, the balance sheet, also known as the Statement of Financial Position. As a CPA, I will walk you through how professionals read a balance sheet and how you can use it to assess a company's financial health in minutes. Today, we're diving into one of the most important financial reports of any listed company, the balance sheet, also known as the Statement of Financial Position. As a CPA, I will walk you through how professionals read a balance sheet and how you can use it to assess a company's financial health in minutes. Before we begin, just a quick note, this video is educational content only, not financial advice. A balance sheet shows a company's financial position at a point in time, what it owns, what it owes, and the net value belonging to shareholders. It follows a simple formula: assets equals liabilities plus equity. Listed companies break the balance sheet into three main sections: assets, liabilities, and equity. Assets are everything the company owns that has economic values like cash and investments, property and equipment, and accounts receivables. Liabilities, all obligations the company owes to others, including bank loans, suppliers' payments, and accrued expenses. Equity, what's left for shareholders after paying all debts. It includes capital, retained earnings, reserves, and revaluations. Current assets are the liquidity lifeline. Current assets represent resources the company expects to convert into cash within 12 months. These assets fuel day-to-day operations and meet short-term obligations. Cash and cash equivalents, how much liquidity the company has. Trade debtors receivables, money customers owe. Inventory stock to be sold. Other current assets, prepaid expenses, short-term deposits. Strong current assets equals good short-term financial strength. Non-current assets generate value over multiple years and represent the company's long-term investment in growth and operations. Non-current assets provide long-term value to the business. Property, plant, and equipment are physical assets like buildings, machinery, vehicles, and technology infrastructure essential for operations. Intangible assets are goodwill from acquisitions, patents, trademarks, licenses, and brand value. Listed companies often carry significant intangibles from merger and acquisition activity. Investments in subsidiaries or associates are stakes in subsidiaries, associates, joint ventures, plus deferred tax assets that provide future tax benefits. The next balance sheet section is current liabilities. Current liabilities are obligations the company must settle within the next 12 months. Managing these effectively is crucial for maintaining operational stability. Trade payables, amounts owed to suppliers for goods and services. Extended payment terms can improve cash flow but may strain supplier relationships. Short-term borrowings are loans and credit facilities due within 1 year. High levels of short-term borrowing may indicate liquidity constraints or aggressive financing strategies. Provisions are estimated future obligations and current tax liabilities. Watch for unusual provisions that may signal pending issues. Watch for the red flag. If current liabilities grow faster than current assets, the company may face liquidity pressure and struggle to meet short-term obligations. Now let's check non-current liabilities. Understanding long-term debt is important to check companies' health. This area helps us assess long-term financial risk and leverage. Non-current liabilities extend beyond 12 months and reveal the company's long-term financing structure and financial risk profile. Long-term debt are bonds, bank loans, and other borrowings with extended maturity dates. Lease liabilities are long-term rental commitments for property and equipment under IFRS 6. Deferred tax liabilities are future tax obligations from timing differences. Long-term provisions are restructuring costs, environmental cleanup, or warranty obligations. Equity represents the residual interest in the company after all liabilities are paid. It's what shareholders truly own and grows as the business creates value over time. Contributed equity or share capital is money raised from shareholders. Retained earnings are accumulated profits not paid as dividends. Reserves would be asset revaluations, FX translation, share-based payment. Consistent equity growth over time generally signals a healthier, more valuable company with sustainable business practices. Net asset. Net assets show the value of the company that belongs to shareholders after paying off all debt. The current ratio is calculated by dividing a company's current assets by its current liabilities. The current ratio has declined slightly from 1.88 to 1.74. This means the company still has more than enough current assets to cover its short-term liabilities, but its liquidity buffer has narrowed. Possible causes for declined current ratio could be faster growth in liabilities or slower growth in liquid assets. The equation for the debt to equity ratio is total liabilities divided by shareholder equity. The ratio is unchanged, indicating a stable capital structure. For every $1 of equity, the company carries 1.46% debt, a moderate level of leverage. This suggests the company is maintaining its financing mix, neither aggressively deleveraging nor over-leveraging.
The equation for working capital is working capital equals current assets minus current liabilities. Working capital has decreased by $55,000, even though current assets remained flat. But this reflects an increase in current liabilities, which could be due to higher short-term borrowings or payables. Not alarming yet, but combined with the drop in current ratio, it suggests the company is operating with less liquidity cushion. Here's what these numbers tell us. Current asset is stable, cash increased by 11%, accounts receivable decreased by 13%, and inventory decreased by 6%. However, total current asset is stable compared to 2024. So that's how professionals read a balance sheet, not just line by line, but by interpreting the story behind the numbers. If you found this breakdown helpful, make sure to like, subscribe, and share for smart, simple finance insights. In the next video, I will walk you through the cash flow statement, arguably the most important report for understanding how money moves through a business. Because profit is theory, but cash is reality. And remember, stay finwise with CPA Emma.